Imagine someone offers to sell you a small business for £1 million. Is that cheap, fair, or wildly expensive? Today I'll show you a simple, structured way to answer that question. Discounted cash flow, or DCF. We'll cover where it came from, when and why people use it, how it works step by step, and finish with a worked example you can copy. DCF is built on one common sense idea. Money now is worth more than the same amount of money later. That's called the time value of money. £100 today is better than £100 in 5 years because you can invest it, or because inflation eats into future money. Economists were playing with this idea in the early 1900s, and by the 1930s people like Irving Fisher and John Burr Williams were writing about valuing assets as the present value of future income. Later, in the 1950s, Joel Dean and others pushed this into standard corporate finance. Project the cash flows, discount them back, and compare to what you pay. Since then, DCF has become a cornerstone in corporate finance, investment banking, private equity, and valuation work. You see it in company valuations, project appraisals, and major M&A deals. DCF is most useful when you expect a stream of cash flows over time. You can make a reasonable forecast for those cash flows. You want an intrinsic value based on fundamentals, not just market mood. Professionals use DCF to value entire companies or individual projects. Decide whether to invest in a project, capital budgeting. Compare acquisition prices to what a business is really worth on its own cash generation. Why do people like it? It focuses on cash, not accounting profit. Cash is what you can actually take out. It forces you to write down explicit assumptions about growth, margins, and risk. It links directly to the basic finance principle. Value equals discounted expected cash flows. DCF is not the only way to value a business. At a high level, there are 3 big families, multiples and comparables, for example, price/earnings, EV/EBITDA, using what similar companies trade for. Asset-based valuation, what the assets are worth minus the liabilities. Income-based methods. This is where DCF lives, using discounted future income or cash flow. In future videos, we can talk about these other techniques, how to pick good comparables, and when asset-based methods are more appropriate. So make sure you subscribe if you want to learn even more. Today we'll stay with DCF and make sure the mechanics are clear. Now the practical bit, how do you actually do a DCF? We're going to use a simplified version that still shows all the key moving parts. Step 1. Forecast free cash flow. First, estimate the free cash flow the business will generate each year for, say, the next 5 to 10 years. Free cash flow is the cash left over after paying operating costs, tax, and necessary investment in the business. It's the cash that's truly available to owners or to pay debt and equity. Step 2. Choose a discount rate. Second, choose a discount rate. This is your required return, or the cost of capital. It reflects the risk of the cash flows. A safer business has a lower discount rate. A riskier one needs a higher rate to compensate investors. Step 3. Discount each year's cash flow. Third, you convert each future cash flow into today's terms by discounting it. The formula for the present value of a cash flow in year T is PV equals cash flow in year T divided by 1 plus R to the power of T, where R is the discount rate. You do that for each year, then add them up. Step 4. Add a terminal value. Businesses don't normally stop after 5 years, so we need a terminal value to represent all cash flows beyond the forecast period. A common simple approach is to assume the cash flow grows at a constant rate forever and use a perpetuity formula. One popular form is terminal value in year n equals cash flow in year n plus 1 divided by R minus G, where G is a long-term growth rate lower than the discount rate. Then you discount that terminal value back to today as well. Step 5. Sum everything and compare. Finally, you add the present value of the explicit forecast years and the present value of the terminal value. That total is your estimate of the value of the business's operating cash flows. You can then compare that to the current market price or to the price someone is asking you to pay. Now don't worry if that all sounded confusing. Let's work through an example and it will become much clearer. Suppose we're valuing a small, stable service business. We expect free cash flow of £100,000 next year, and we think it can grow that cash flow by 3% per year for the next 5 years. We'll use a discount rate of 10% to reflect the risk. Using our PV formula from earlier, we can calculate the present value of the forecasted revenue over those 5 years. In year 1, it is $90,900. Year 2 is $85,100. Year 3 is $79,800. Year 4 is $74,700. And finally, Year 5 is $69,900. Adding those present values together, the first 5 years of cash flows are worth roughly £401,000 today. Now we add a terminal value. Assume that after Year 5, the business keeps growing its cash flow at 2% per year forever and still deserves a 10% discount rate. Cash flow in Year 6 would be roughly £115,800, that's Year 5 cash flow grown by 2%. So terminal value at the end of Year 5 is $115,800 divided by 0.1 minus 0.02, which comes to $1,447,500. So the terminal value at the end of Year 5 is about £1.45 million, but that's in Year 5 money. To get today's value, we discount it back 5 years at 10%. So the present value is that 1.45 million divided by 1.1 to the power 5, which comes to around 898 thousandths. Now we have PV of years 1 to 5, about £401,000. PV of terminal value about £898,000. Total DCF value is roughly £1.3 million. So if someone offers you this business for £800,000, your DCF suggests it might be attractively priced, assuming your assumptions are sensible. If they want £2 million, it looks expensive on these numbers. To wrap up, DCF asks a simple question. What are the future cash flows worth in today's money? It's powerful because it focuses on cash, time, and risk, which are at the heart of finance. It does depend heavily on your assumptions, so it's not a magic number generator, but it is a disciplined framework. In future, we'll discuss how you might calculate those assumptions about future cash flow. Next time, we can look at other valuation methods like multiples and asset-based approaches and see how they compare with DCF in practice. So if those sound interesting to you, please consider subscribing. I'll see you in the next video. Take care.